I think for the very first time in my career, not only are all the people I'm talking to afraid and concerned, I am. I emptied my own personal bank out of US Bank the other day before they came out and rewrote the rules, because I'm very, very, very concerned about where this is leading. And I think it's just the beginning.
During the Senate Finance Committee hearing on March 16th, former Fed Chairman and current U.S. Treasury Secretary Janet Yellen gave her remarks that while the general economy may be improving, millions of Americans are still struggling to make ends meet. Yellen acknowledges that the COVID-19 pandemic has hit the country hard, with many losing their jobs and businesses, and the road to recovery is long and uncertain as Yellen discusses the potential for bank failures, which could lead to a collapse of the U.S. financial system. Yellen attempts to reassure the public that the U.S. financial system is strong and well-regulated, but her tone is not convincing. She acknowledges that the government has measures in place to prevent and address any bank failures, but it is clear that the situation is fragile. The future is uncertain, and the possibility of a financial disaster is a constant threat. U.S. Senator James Lankford expressed his dissatisfaction with the decision to bail out the failed Silicon Valley Bank and Signature Bank. The argument proposed by Lankford was that if deposits at these large institutions are guaranteed, what's to stop individuals from pulling money from the local regional banks and depositing with the large banks? As interest rates continue to increase, this is precisely what's expected to happen. That portion of the conversation is seen here.
What is your plan to keep large depositors from moving their funds out of community banks into the big banks? We have seen the mergers of banks over the past decade. I'm concerned you're about to accelerate that by encouraging anyone who has a large deposit in a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole at that point.
Look, I mean, that's certainly not something that we're encouraging.
That is happening right now.
That is happening because depositors are concerned about the bank failures that have happened and whether or not other banks could also
No,
fail.
it's happening
And
because you're fully insured no matter what the amount is if you're in a big bank. You're not fully insured if you're in a community bank.
Well, you're not fully insured. And
you were at Signature, and it just barely met that threshold. You were at Signature.
Well, we felt that there was a serious risk of contagion that could have brought down and triggered runs on many banks. And that's something, given that our judgment is that the banking system overall is safe and sound, depositors should have confidence in the system.
Andy Schectman, president of Miles Franklin Limited Precious Metals, goes on to give his thoughts about the comments by Janet Yellen.
In other words, those banks, she said, that in our minds are too big to fail, the systemically too big to fail banks. In essence, what she was saying was that all of those smaller banks are dead on arrival. They won't be bailed out. And if they're not deemed to be systemically important, then they will have no backstopping. And what that is basically doing is herding everyone into a pen of the 4, 5, 6 biggest commercial banks in the world, or in the United States, the Wells Fargos, the Bank of America, the Citi, the JP, the Goldman. All of them are going to be too big to fail, systemically too big to fail, interconnected with one another, whereby if they fail, they'll bring down the whole system.
Let's deep dive into the phrase too big to fail to understand the context behind why this is so important. The term originated in the United States during the 1980s in the aftermath of a series of high-profile bank failures. Specifically, it was used to describe the idea that certain financial institutions, particularly large banks, were considered so essential to the functioning of the economy that they could not be allowed to go bankrupt or otherwise fail. The term gained widespread use during the savings and loan crisis of the 1980s and early 1990s, when the U.S. government was forced to bail out numerous savings and loan institutions that had engaged in risky lending practices and were facing insolvency. The government justified these bailouts on the grounds that the failure of these institutions would have had a catastrophic impact on the broader economy. The term resurfaced and gained renewed currency during the 2008 financial crisis, when a number of large financial institutions, including Lehman Brothers and AIG, were on the brink of collapse. The U.S. government intervened to bail out these institutions, arguing that their failure would have led to a widespread financial collapse and economic depression. Since then, the concept of too big to fail has been the subject of much debate, with some arguing that it creates a moral hazard by encouraging banks to engage in risky behavior with the expectation of being bailed out in the event of failure, while others maintain that it remains a necessary policy tool to prevent financial crises. This is what Treasury Secretary Janet Yellen was referring to. Now let's hear what will happen to the smaller regional banks in this case.
But the little banks who run into trouble, those banks, no, they won't be bailed out, and too bad. And what that's going to do is collapse the entire small banking industry, the entire regional bank industry.
As we can see from the public data on FDIC's website, bank failures are a common occurrence in the United States. Since 2001, some 563 banks across the country have failed, including a high of 157 at the height of the Great Recession in 2010, so this isn't anything out of the ordinary. Nor is it too far-fetched to believe there aren't going to be more failures coming soon. I guess the next question would be what exactly causes banks to fail.
So most of these banks have virtually nothing in the way of currency on hand, and because they would take these deposits that came in from the depositors, and they would buy bonds with them. And so the problem is that since interest rates have risen closer to 5%, every one of those bonds in their portfolio have lost 50% or more of their value. Now, the banking regulations say that they don't have to mark those to market until they sell them. And so they have a whole balance sheet filled with toxic assets that have lost over half their value or more.
Back in May of 2018, Congress passed a law that ordered the Fed to reduce regulatory burdens on community and regional lenders. This led to a proposal where banks with more than $700 billion in assets would no longer have to hold as much cash or liquid assets in reserve, as they would be considered less risky and less likely to fail. The proposal would also reduce the frequency with which these banks are required to report their liquidity positions. Critics of the proposal argued that it would weaken regulations put in place after the 2008 financial crisis, which were designed to prevent a repeat of the events that led to the Great Recession. They also argued that the proposal could increase the likelihood of bank failures, as it would reduce the amount of liquid assets that banks have on hand to weather a potential crisis. Which brings us to the present time with Silicon Valley Bank.
So in the case of SVC, when you saw a run on the bank, for whatever reason, you get people running on the bank, because there's so little cash, the reserve requirements have been slashed to nothing, these banks are forced to sell their bonds at a huge loss in order to meet customer demands to get their money back. And if enough people redeem or withdraw their money, and the banks are forced to liquidate their bond holdings, which have been eviscerated by rising rates, then a large bank can become insolvent in less than 24 hours.
It's unfortunate that in less than 5 years after this law was passed, we are experiencing the ramifications of loosening regulation standards. Just imagine what's next.
The banks are in trouble. We're going to increase the tremendous amount of inflation that's already into the system. We're going to increase it to bail out those banks that are systemically too big to fail.
But what if this is all by design? What if this is part of a long-term plan to crush the dollar? And what's going to happen next if more regional banks fail?
Everyone's going to flood into the commercial banks, and then they are ripe for whatever they have in mind. If they let one of them fail, just one, everyone will panic and embrace the new CBDC currency, which we have been told by the Bank of International Settlements that everyone must have. All countries that are part of that network, the BIS network, has to have an operational CBDC by 2025. Who knows? Maybe we'll have one much sooner than that, the way that this is all going, but this is very frightening.
CBDC stands for Central Bank Digital Currency. Digital currencies are electronic forms of payment that are an alternative to traditional cash and credit cards. Many of us already utilize digital currency in our everyday life. Think Apple Pay, PayPal, Zelle, Cash App, etc. CBDCs are a type of digital currency that is issued and backed by a central bank, making them different from cryptocurrencies like Bitcoin that are decentralized and not backed by any government entity. CBDCs can help central banks better monitor and regulate the money supply, as well as prevent financial crime, which is where the issue of constant monitoring and personal privacy issues come into play. We are essentially prepping the stage to move into a cashless society. Every time you exchange your digital currency, it will be tracked. You can read more about this in this 2022 Federal Reserve Payment Study report published by the Federal Reserve. The report notes that the Federal Reserve is exploring the possibility of issuing a central bank digital currency and is also working on improving the speed and efficiency of the payment system through initiatives such as the FedNow service.
Executive order by Biden 14067 was passed a year ago. So they expect the central bank digital currency, the Fedcoin, this year. And when they go to Fedcoin, there goes your privacy. They can track you like a dog via your money.
The United States Federal Reserve is set to launch a digital payment system in July 2023. The system, known as FedNow, has been in development since 2019 and will allow real-time money transfers between banks and individuals, as well as between businesses and customers. This is seen as a major step towards modernizing the country's financial infrastructure and reducing the reliance on paper-based checks. There have been numerous changes to our system of currency here in the U.S., including the creation of the Federal Reserve in 1913, or Teddy D. Roosevelt confiscating gold in 1933, or what about when Nixon devalued the dollar by detaching it from gold in 1971? For this seamless transition to happen, there will be some pain that we as an economy will have to endure, and as history will show, change isn't always easy.
Step number one is to get everyone out of the small regional banks out of fear, herd it into the big commercial banks, and we are seeing a massive consolidation. And that's exactly what is happening, because they are going to pick and choose who they backstop and who they don't. This is something that is so crazy that I think it's going to have rippling effects throughout the entire banking industry, and you will see bank runs, and a lot of them. And I think for the very first time in my career, not only are all the people I'm talking to afraid and concerned, I am. I emptied my own personal bank out of US Bank the other day before they came out and rewrote the rules, because I'm very, very, very concerned about where this is leading. And I think it's just the beginning.